Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 277. Today is 6th of September 2022 and the topic for the day is why most investors lose. We know by statistics that about 70 to 80% of fund managers are not able to beat the benchmarks. And I would imagine an equal number of percentage of people are not able to even achieve the returns these funds or these PMSs or any vehicle that they choose because of their own investor behavior. So we will dive into a bit of investor behavior aspects in terms of why investors lose despite the vehicle that they've invested in may be making money. One announcement tomorrow, Wednesday, 7th of September, 7:30 p.m. I will be talking to Mr. Udupa here on beating Nifty 50 with momentum. So it's a Ask Me Anything round. It is being brought together by Smallcase, and this will happen tomorrow at 7:30 p.m. So you can watch it on YouTube, and we'll give you all the links also. So market was again after a couple of days of that sideways within that larger move basis. Today also we remained restricted despite the weakness in the US market yesterday. We remained restricted to that band. So there have been sort of three inside days since that large bar that we got last Tuesday. And I think it is time to sort of move from here in the sense that within the next couple of sessions there should be a large move. Which way that goes is anybody's guess, but we are very close to that trend line resistance on the Nifty, and if there is some positive tailwind from anywhere, I think we'll go up very dramatically. I'm not really looking at a downfall, but who knows, I'm usually wrong 50% times when I try to predict something. So the internals of the market, metals made a comeback. There was talk about export duties being reduced on metals, so metal stocks did well. Energy stocks have been running all right. Commodities also went up with the metals. Banking has been doing reasonably well today. PSU banks recovered. Real estate was all right. The sectors that were sulking were FMCG, some private banks, IT stocks, and some auto stocks. So nothing majorly directionally trending right now, but the current mood seems to be wait and watch till that next move on the entire index happens. I think India markets have been wanting to go up, but global markets have been a bit soft, and hence there is some sort of a decoupling that is happening. Whether that will result into a complete taking out of that resistance or not, that is to be seen. Broader indices, Nifty closed flat, but Nifty Next 50 was up 0.6%. Mid and small cap index also up 0.3 to 0.4%, and other broader indices were up 0.12%. Best performing weekend investing small case today was NNF 10 plus 1.42%, ATH also 1.1%, and most others between 0.25% to about 0.7%. MI50 lost about 0.5%. Overall heat map of the day: Reliance up 1%, FMCG stocks down, levers, ITC, Nestle, Britannia, Tata Consumer all down, Bharti Airtel doing quite well. Some energy stocks, Power Grid, NTPC are doing very well. Tata Steel, Shree Cement, Grasim all right. IT stocks still sulking, but I think the drop after a Nasdaq fall last night has been quite muted. So maybe we are coming close to some sort of a bottoming here. And mixed bag on banking. Some PSU banks were up, but largely I can see that the banking and finance was overall a weak sector today. Top gainers: GMM Pfaudler up 9%, Gujarat Alkali, Sri Renuka up 8%, Vijaya Diagnostics and Apollo Tyres up 7%. So big gains on some of these stocks. The ones that were losing were Tata Teleservice, which had run up a lot in the last few days, down 7.5%. Triveni Turbine down 6%. Dhani Services, Brightcom Group down about 5%, and CCL Products down 3.5%. So this is something that I tweeted this morning, rather this afternoon, and there was an interview that I did this morning, and the person asked me, why do most retail investors lose? What has been your experience in the last 25 years in the market? And I asked this question on my Twitter feed, and I got a lot of response to this. So my suggestion to you is, please go and read this tweet thread. I'll also provide you with the link of this. The responses, several of them were very, very intelligent and knowledgeable responses. Of course, my own response is also very close to them. So here Medhavi Pandey is saying retail investors lose because they do not have a specific plan or strategy. I fully agree with that. And chasing fads and hearsay, also many normally enter when noise starts at peak of bull market and moving out in despair when crash comes. So this is probably summing it up very nicely here. I often give you the example of Peter Lynch, who ran the Magellan Fund, and he was the best performing fund manager for 13 years, doing a CAGR of 29%. But most of his investors did not make money. The sole reason for that is that the investors were trying to beat the fund by their own timing of entry and exits. And in the years he did very well. At the top of that year, people were bringing in large sums of money. And in the years he was not doing well, people were taking out money hoping to re-enter at a lower stage. So once you have allocated your money to a professional fund manager, or you're following a professional fund manager in a small case, or you've given the money in a PMS, etc., please allow that manager to do his job for your capital. If you're going to play a backseat driver to this vehicle, the vehicle is going to go all over the place, and you will not make even the average result that fund was supposed to give you. So this is very important that you concentrate on your profession, your work, and allow the fund manager to do his. And if you are going to be driving the seat here, then don't give it to the fund manager, do it yourself. I mean, if that is sort of the confidence and the performance that you have for yourself. Srinath added that because a lot of folks pray to a recommendation like this, so of course a lot of tips, a lot of hearsay, a lot of want to make a very quick buck. A lot of people still today are in this habit or maybe this assumption that you need to be bringing in money and taking it out, So this concept of trying to time it and pick that one stock that is moving right now and move out is for the experts only. I mean, if you are really good at that, you'll make a lot of money doing that, and there's no harm in that. But if you are having a 9-to-5 job and you're trying to do this on the side, that I'll try to time it and at 2 p.m. I'll enter and at 3:30 I'll get out, I think don't try all this. I mean, have a peaceful career wherever you are, and you allow your money to be managed by somebody else. Amber says, not able to follow any system properly, root cause is desire to outsmart even a proven good. So exactly the same point again, that if you have a proven system, and that proven system could be as simple as an index fund. So an index fund gives you 12, 13, 14% CAGR over a longer period, as we have seen in the last 5-10 years. Why do you want to, disturb that? If you want to really trade or do some, second order sort of timing, do it with some other fund on the side. Allow this vehicle to compound itself. The index itself is a momentum investment index. So, stocks will go out if they're weak, stocks will come in if they're strong. Allow it to, do its thing. Abhijit is adding, one is herd investing. Yes, so that's very true. A lot of folks come to the market once the market has done its run up and people are feeling FOMO and, there's herd mentality that, I should also join now. So So that is definitely a reason. Uninformed decision making, investing without knowing major offerings, top line, debt position, etc. So poor research, and I don't blame people for this, because doing research for stocks and doing it for over hundreds of stocks is a full-time job. If you are gainfully employed in your business or profession, you can't do it. Unless you have very deep passion that after your work you are able to burn the midnight oil and do all this research. It's very, very difficult to keep up. It's a very fast moving, fast paced market, and without a system, without proper decision making, is very difficult to do. Entering at peaks, emotional buy and hold calls, blindly tiptoeing stock picks, daydreaming about overnight success. So this point is also very important, that coming to the market with realistic expectation. In some year, if somebody has made 100% or 200%, that cannot be the norm for you to come to the market and expect that. See that over a longer period of time, people have made maybe 15%, 17%, 20%. That should be the sort of your goal to achieve in long-term investing, rather than try to pick some occasional or some fluke year. Like 2021, for instance, where everybody made a lot of gains. To be realistic to that extent. Rahul says, be absolutely simple, lack of clarity due to lack of right and concrete education. So simplicity is something that I adhere to and I promote a lot. There are two things. One is that simple things are simple to understand, simple to execute, but not easy to do, in the sense that everybody knows that you can go and run 5 kilometers a day and have good health, but is it easy to do? It's a very simple thing to understand, but it's not easy to do. So simplistic approach to market will keep your number of variables that you need to decide for exit, entry, position sizing to a very simple way. Like in weekend investing, we just use equal weights, for instance. We just have a algorithm that tells us, these are the stocks to buy right now, these are the stocks to exit, or do some ranking. So some simplistic methodology, process, procedure that will allow you decision making in times of stress, because when the time will be there when market will make you stress, there is drawdown and there's all kinds of fear psychosis in the market. At that point of time, if you have a complicated system, you will not be able to take a decision, because there will be 10,000 variables moving in different directions. If earnings is going down, you will try to latch on to management is good, I should hang on to this company. If management is changing, you may say earnings was very good, I'll latch on to this company. Or market share is coming down, you'll say the sector will improve in the next year. So you will find ways to justify your action of either maybe not exiting or exiting too early, so on and so forth. So clarity and simplicity extremely important. Dhawal is adding listening to noise and making investment out of hope rather than having a streamlined framework. So again, this hopium trade, that I bought something and now this price has to be achieved. I bought at 300 and now it is at 160. So now this 300 has to come. It is not necessary. I mean, the market owes you nothing. That price is your price. You chose to buy at 300. The market or that stock need not ever come to 300. At 300 it was justified at that point of time. At 160 it is justified now. So having a framework, having process to get out when you need to get out, process to switch to other stocks, not having this I'll keep this stock till my graveyard type of mentality. So please don't do all that. So as I said, this thread of this tweet is gold. Please go through it. A lot of people have contributed their ideas. I think, and that's my belief and my reading, a lot of folks on Twitter are extremely savvy and next level of retail investors. So there's lots to learn from each other on Twitter. I too learn a lot from a lot of messages that come in, and a lot of these responses are great. My own response in that interview, by the way, was this behavior and emotions. So emotional connect is the main reason, according to me, why I saw thousands of retail investors when I was in the brokerage business fail or not do so well, because once you bought a stock, you did enormous amounts of research, you purchased products of that company, you saw that hoarding of that company and felt happy, you were married to the stock, you were blissfully wedded until some thing happened and the stock was not going your way, and then divorce is very, very difficult to do, and if you are able to do it, it is extremely painful also. So again, everything comes down to emotions and behavior, how you are going to behave if such a condition arises, how you are going to behave if some other condition arises. Your behavior, as I said in the Peter Lynch case, investor behavior caused them to not even achieve what Lynch achieved for the fund. I mean, how sad is that you chose the right vehicle, the right fund manager, you bet on the right fund manager, but because of your own emotions and behavior, you were not able to achieve what he was able to give you on a platter. So please do think about all this when you invest, and make sure that either you give your full effort and you are able to beat what you're trying to do, but don't just play around with things and ruin what you were about to get in any way. So please do come to the AMA session tomorrow and share this video if you think your friends and family can get some help from it. Thanks. Bye.